radio. You can find it on 102.3 FM or 1050 AM out of Redlands, Loma Linda area. I've been talking with Rob Overstreet about his journey in multifamily investing. And so we've kind of covered the how you got here and what it means to you a little bit. Getting into this kind of the dirt, I guess, the economics. There's a lot going on. So much going on in politics right now, so much changing the way we're handling things now post-COVID. What's the kind of general outlook that you have of the asset class right now?
Yeah, our outlook is bullish, but there's so many influencing factors, Dan, as you kind of alluded to. And yeah. I'll start by, and I'm sure many of your listeners know about, cap rates as a measure of value of apartment deals and other commercial asset classes, office, industrial,
for
retail.
Maybe some of the new listeners, what is a cap rate real quick?
Yeah, cap rate is a measure of yield, unlevered yield. So basically you have all of your income, right? So your total collected income minus all of your total expenses, your operating costs, including payroll, repairs and maintenance, all the usual
for 1 year,
stuff.
Right?
Yeah, for a 1 year period. And then, so income minus expenses gives you your net operating income, your NOI. And NOI and purchase price are two of the factors for calculating the cap rate. And so, for example, if I'm looking at a deal that is generating an NOI of, let's say, $100,000, and we can buy that property for $1 million. Okay, $100,000 can go into the purchase price 1 million 10 times. That's a 10% cap rate. Yep. Which, by the way, if any of your listeners have any 10 caps, I would buy all of them off of them today. So,
I think everyone would. Absolutely.
Yeah, that's an exceptional yield. But in my day to day, week to week, on the phone with brokers, we're always talking about the cap rate. What's the cap rate? What's the cap rate trading at? What's the cap tomorrow, this day, that day, whatever. And so in today's world, so backing up, generally speaking, the lower the cap rate, the higher the price of the real estate. Okay. The higher the cap rate, the lower the price. Okay. So it's kind of inverse there. Again, measure of unlevered yield. It doesn't factor in, your debt service payment. Right. And so a couple of years ago, in some of the markets that we're looking in, we could find 6-7% cap rates, right? In decent areas, and those were good deals. And cap rates, by the way, are always in flux. They're always going up. They're going down, sideways. And it's all. There's more to it. It's also a function of risk. You could have the same city, but the bad neighborhood might be selling for an 8 cap, meaning the real estate costs less, versus the downtown prime main location might be selling for a 3 cap, which is, less risky. Right. And so the risk factor plays into the cap rate as well. But
so what's driving that then? The risk factor specifically, what's driving the risk factor for you today?
Well, people's opinion, everyone knows on this side of the tracks or the other side of the tracks, it's like, that's a little bit heavier, lift, or maybe it's a rougher area. And so, investors respond to that, the buyers, right? And so it factors into the cap rate. But on top of all of that, that's on the micro level. There's also macro level influences into cap rates, not only market to market, city to city, but also on a national level. So a couple of years ago, in some of the markets that we look in, we could find a 6 cap or 7 cap, and that's a pretty good deal, and it's a good yield. We can pay our investors the cash flow, and if the deal had a story to it, we can add some value and appreciate the deal based on our operations. Today, nationally, cap rates have been declining steadily. And really it started since the last kind of, I'll call it the financial meltdown of 08 and 09. Cap rates went up, and ever since, call it 2010, cap rates nationally have been on a steady decline, meaning the prices of real estate have been going up for commercial. Okay. And so, we would pass on deals a few years ago at a 5 or 6 or 7 cap that today are trading at 3 to 4% cap rates in some of the
Oh,
markets.
wow.
And so to put numbers on
that's pretty quick change.
very quick change.
Wow.
And there's a lot of factors that are contributing to that. Cap rates historically kind of, they follow and they have a positive correlation with the direction of treasury rates, right? Interest rates.
Mm-hmm.
And so interest rates have been on the decline over that same period. And so have cap rates. If we can borrow money at cheap rates, we can afford to pay more. And so it's driving down cap rates, right? But my point here is I wish for all those 6 and 7 cap rate deals we passed on 4 or 5 years ago, I wish we'd have backed the truck up and bought every single one of them. Yeah. Because it would have made so much money. Now, your question was to do with kind of where we are today and where we go from here. I think that there are some contributing factors that suggest that cap rates may continue to decline, at the very least run sideways. Now, some people may argue with me that, well, Rob, Powell, our current Fed chairman, is going to raise rates this year. That's true. I believe that he will. It's pretty much widely known that he's going to raise rates, probably multiple times. That's fine. I would argue that despite interest rate hikes, that at least in the short and medium term, that cap rates stay compressed and don't move very much because of all the liquidity in the monetary system. They've printed,
there's a lot of money out there. Yeah.
They've printed $5 trillion, Dan, in the last 18 months. And I know
that's an incredible number.
Yeah. And so,
oh, man.
That plays an influence. All that money is looking for yield.
Right.
And so there's a lot of buyers out there. There's a lot of fresh powder, a lot of equity, a lot of people trying to get in the space and protect their investments, and they're using real estate and they're using apartment real estate. And so I believe that unless treasury rates increase at, in a material way, right? If Powell does these little, nickel and dime changes here and there, I don't think that this train stops steaming down the tracks personally.
It's got a lot of momentum.
It's got a lot of momentum. There's a lot of demand, and there's a lot of newly minted money out there that's seeking yield. And I'll take it a step further. If you go to other, I'll call it, established countries, or different cities around the world that are first world, kind of areas, their cap rates are even lower. I mean,
and they have been for a while too.
So go talk to an apartment investor who does what I do in London or Toronto or Tokyo or Singapore. They're buying deals at like a 1 to a 2 cap. So
that sounds unreal.
and so while we all sit around, me, my peers, my competitors, whatever you want to call it, we're all in the US apartment real estate game, complaining about how far caps have compressed. It's still on a global, scale. It's still relatively cheap to buy real estate in the United States.
Everybody's coming here to buy stuff. Still.
That's right. So, that's my 2 cents. You talk to 10, commercial real estate economists, 5 of them on this side, 5 of them on that side, they'll disagree. I mean, I listen to and I read articles from a lot of very smart people, much smarter than me, and I digest it all. And I mean, there's brilliant minds that disagree with each other on where this goes from here. Today, I tend to believe that we're going to continue to see low caps, and they may even continue to decrease.
Wow. That's incredible. What are you doing with your strategy then? How have things shifted in the last, say, 3-4 years?
Okay. I just did the whole cap rate speech. And so, and all of that said, if you'd asked me 5 years ago, it was all about the cap rate. Today, cap rate is becoming less relevant. What's becoming more relevant, in my opinion, is the story of the real estate. And that's always been relevant, right? For all those real estate investors out there listening to this right now, that the story matters, right? The location, Who owned it? What did they do to it? What can we
Yeah.
buy it for? And you've heard it before. You make money when you buy, not when you sell, right? So
Just about every time.
so strategies, we look at the basis. What's our going in, price per door, price per pound, price per foot? Does that feel right? Does it compare with, sales comps? But even more than that is, where can we take the deal in the next 1, 2, 3 years? Is there value add, real value add? Because as we talked about with the cap rate, the value of these properties is based on the income that they generate. So we can, quote unquote, force the appreciation if we can identify and solve, a number of issues: low rents, high expenses, some kind of functional obsolescence, where if we can, increase our NOI. Right. Again, that formula, NOI, price, and cap rate, for every dollar that we drop to the NOI, we're increasing the value. So now more than ever, it's location and it's story of the deal. Can we execute on our business plan?
Wow. So the same sort of stuff, but you're just compressing into other methods to get there, it sounds like.
Bingo.
Wow.
Yep.
All right. Well, we're at the end of this segment right here. So we'll be back after a couple of commercials here on the Real Men of Real Estate and KCAA Radio out of Redig.